and they applaud complete idiots, which probably is the reason the US economy did so well. They didn't have economists. This is one of the tenets of modern economics. This is an explanation of the depression. Wall Street controls the Federal Reserve, Milton Friedman, and he explains exactly the damage, the social consequences of money printing and inflation are.
Marc Faber, editor and publisher of the Gloom, Boom and Doom report. It is a true pleasure to host you on Palisades Gold Radio today.
Well, thank you for having me, and thank you for your viewers to give me the opportunity to share some of my views.
Excellent, Mark. I am really excited for this chat, and there's a lot of topics I would like to cover, but perhaps we should start big picture for a second. As you well know, we're in the midst of an incredible bull run in the precious metals complex. Currently, it's the 6th of January 2026. Gold's trading very close to $4,500 an ounce, silver very close to $80 an ounce. Absolutely incredible returns. Now, when we talk fundamentally for a second, Mark, biggest drivers behind this move, what do you think have been those biggest drivers behind this meteoric rise in the precious metals complex?
I've been involved in gold essentially since 1970-71, and we had the big bull market after August 15, 1971, because the US went off the gold window, and then gold rose from $35 an ounce to $850 an ounce in 1980. And after that, we had a bear market that lasted essentially until 1999, when you could still buy gold at $253. That was the low at the time. And then we had the big bull market until 2011. And then again a bear market until 2015, when gold briefly went below $1,000 an ounce. And since then it didn't go up a lot, but it went up a lot in the last 2 years, 2024, 2025. And, you know, markets are funny. We have in the world this money printing by the central banks. This is a fact, undisputable fact. And the money that is being printed flows then into financial institutions in the world, insurance companies and banks and financial companies and so forth and so on. And then it flows further into all sorts of things. It can flow into commodities, it can flow into food prices, it can flow into wages, it can flow into stamps, it can flow into real estate, it can flow into Chinese stocks, US stocks, but it doesn't flow evenly and lifts the price level like this. But no, the price level goes up here and then there and so forth. And so this was already observed by Copernicus, that this money printing essentially lifts prices, but not evenly. And this not evenly leads to prices of some things or assets to lag behind, like gold lagged behind the S&P for a long time. But since the year 2000, gold has outperformed the S&P massively, I may add. And so I could argue gold and silver and platinum went up in order to adjust to the increase in prices that we have experienced and what people commonly called inflation. They don't say the stock market is inflating. They say the stock market is going up in a bull market, or they say the property market is strong. But whether properties go up or food prices go up, or your insurance premium for your car goes up, and so forth. It's the same. It's a symptom of excessive monetary growth that leads to price increases. Without these price increases, you wouldn't have bull markets in stocks and in properties to the extent that we had them. But you have to understand, the central banks, they are encouraged by Wall Street and financial people around the world to print money. And why? Because more money leads to bigger assets. And how do Wall Street and the fund managers and the financial service industry gets paid? By the size of the assets. If I manage $100 million and there's a bull market and the portfolio goes up to $150 million, then I get bigger fees. So the last thing I want is that the portfolio drops from $100 million to $50 million. That is the disaster. So the financial industry, no matter how bad the social consequences of money printing and inflation are, the financial industry will always applaud money printing. And they applaud complete idiots like Yellen and Bernanke and so forth that basically are clueless about history and clueless about how prices move in an economic system.
Incredibly interesting point there, Mark, about the incentives of central bankers to continue to print money. A lot of analysts focus on the government side, where you see these enormous debts that we're seeing that need to be printed away as they are unsustainable. They cannot be paid off from GDP. At least a lot of people would argue that. And when you add on these incentives to print money outside of that, well, this seems to be the outcome.
I don't want to brag, but I've read quite a lot of economic books, and I studied economic history. I was always interested in economic history, and especially the history of financial upheavals and so forth. So there are different theories in economics. I belong to the traditional classical economic school, which existed prior to American economists and prior to people like John Maynard Keynes, which is nowadays it's called the Austrian school, but it was the only school because in the 18th and 19th century there weren't any economists in the US, which probably is the reason the US economy did so well. They didn't have economists.
Today's episode of Palisades Gold Radio is proudly brought to you by our parent company, Palisades Gold Corp, Canada's leading junior resource investment vehicle, trading on the Toronto Venture Exchange under ticker symbol PALI, with equity and warrant positions in over 200 companies, ownership of mineral projects and royalties, and a significant stake in newfound gold. Palisades offers investors powerful leveraged exposure to precious metals, uranium, copper, and other critical minerals. Palisades shareholders directly benefit from our team's extensive industry knowledge and access to deal flow, opportunities historically reserved for a small group of investors. To learn more, visit us at palisades.ca and join us in our mission to level the playing field for investors. Now, back to the show.
But then came the 20th century. The result of Keynesian economic theories caused a lot of damage in the world. And he as an individual also caused a lot of damage because he was the president of the British Eugenic Society. The Eugenic Society of America supported Mr. Joseph Mengele in Nazi Germany. This is a fact. This is not an invention by me. Every history book points this out. The Austrian school of economists is arguing for small government and for little interventions into the economy, which was also explained in details, and everybody of your viewers should do that. Go back to 30 or 40 years to speeches of Milton Friedman. They are brief, they usually last 10, 15 minutes, but he's a brilliant speaker, and he explains exactly the damage governments cause onto the economic system. The worst case of government interference into the economy is, of course, socialism and communism, where the government will tell you, you do this and you consume that, and you have to produce such and so forth. But the Austrian school, the classical school, is more the Adam Smith type of economics. Economics that make common sense. But under the influence of Keynes, more and more the government intervened into economic activity, and in order to finance the expanding government, do you understand? This is one of the tenets of modern economics. The government officials want to expand the government apparatus because it gives them more power. And to do that, they need a central bank to print the money to finance the government's expansion. And so the money supply always increases. And I'm not saying always, but under certain conditions and economic circumstances, what you then get is inflation, price increases somewhere in the system. As I said, it's not regular, but somewhere prices will go up.
Incredibly interesting. What you outlined there, of course, historically speaking, inflation isn't a constant. Money printing isn't constant. There's been periods like the 1800s, 1800s in the United States where money printing was relatively low and prices were therefore also relatively stable. And this government expansion that we're seeing now in the United States, I believe 25% of GDP is being spent as federal expenses each year, currently speaking. They've definitely grown substantially.
More than 25.
Okay.
But what you're saying is absolutely correct. You know, between 1800 and 1900, the U.S. had tremendous growth in per capita incomes and in prosperity. Partly the prosperity arose, contrary to what most economists will tell you nowadays. This prosperity arose because prices went down. The price of transportation went down, and because of the introduction of farm equipment, such as tractors and so forth, the prices of agricultural products went down, and so the affordability increased, and real wages of people increased dramatically. In other words, the problem nowadays is affordability. As you know, prices go up, wages also go up, but they go up less than prices. So in real terms, inflation-adjusted terms, wages buy less than before. I mean, you see it in a department store, what the prices go up, you would have to be blind not to see it. And two, there are hidden price increases. Let's say I buy some medicine packages. You know, you buy a package like this, before there were 10 pieces inside, and now there may be only 8 pieces inside.
Well understood, Mark. What do you think of these economists and historians that are trying to make multi-factor models that try to capture the money printing, inflation, cultural cycles? For example, Ray Dalio or the fourth turning as an example, these 80 to 100 year cycles. Do you believe that's a correct framework to look at the world?
Well, I've been always interested in economic cycles, and I studied it thoroughly because one of the economists that interested me, historically seen, was Kondratiev. and he became famous because of his Kondratiev cycle series. And then I studied the cycle series of Kuznets and of Juglar and of Benner and so forth. There's so many cycles, you know. And Robert Prechter, who is a friend of mine and the founder of the Elliott wave theorist, a brilliant technician, I might add, but brilliant in the stock market also means colossal mistakes. But he is one of the people who wrote extensively about cycles. And that always interested me, and I then also studied political cycles and especially war cycles. War cycles interested me a lot because I think this is a major threat for your and our prosperity, that war breaks out and that the whole financial system breaks down. Then who knows what will happen? So that is something that really captivated me. The problem with cycles is that, you know, you have long-term cycles, say 100-year cycle, but then the 100-year cycle is broken down in maybe medium-term cycles like the construction cycle, building cycle, or Kuznets, which is 18 to 22 years. And then you have the shorter cycle, the Juglars, and then you have the very short-term cycles, the kitchen cycles. They're about 4 years or something like this. Anyway, and then you can be in an upward wave of the Kondratiev, but in a downward wave of the Kuznets. You understand? But within the Kuznets, you could be up in the Juglar, and within the Juglar, you could be down in the kitchen. So we have to be very careful to be not to be too dogmatic about cycles. But the depression years of the 30s is explained that many cycles coincided in turning down. The long-term cycle, the Kondratiev, and the Kuznets and the Juglar all at the same time. And that produced, this is an explanation of the depression. I sometimes think that economists don't know with precision what is happening in the system. I'm a strong believer in cycles. Yes, I believe also in societies. They have a rising society, say the Romans, and then they top out, and then they go down, and then a new society comes up, and so forth. And I suppose our Western society has seen its peak relative to the rest of the world. I mean, you look at Britain in the 19th century, they controlled pretty much the world. Or you look at the Spaniards in the 16th century, it was a very, very powerful empire. And you look at America post-Second World War, say in the 1950s, there's no chance that either Russia or China could have beaten the US in a military sense. But nowadays, the odds are about even, you know, I mean, some people say, no, the US is so powerful. Trump, he believes that the weapons the US have are superior. But this is not the view of experts who think that the Russian army is much better equipped technologically. And they also believe that the Chinese have far superior weapons than the US. So anyway, the great advantage the US enjoyed post-Second World War until, say, the 1970s, 1980s is over. They have now more competition. I'm not saying this will lead to a war, but the conditions for war are particularly good when you have a hegemon, a society that dominates the world, basically, the US after the Second World War. And then you have another society that comes up and threatens the hegemon of the US, the leading position of the US. And that creates, I'm not saying it leads by with certainty to World War III, but it creates the conditions that are very favorable for another war. So this is my answer about your cycles.
No, it's a very interesting Pandora's box that we've opened now, Mark, and I would love to continue talking about it for a second longer. Very favorable conditions for a potential conflict between these two. You know, when you look at this East versus West, United States versus China framework, the US, of course, has a lot of problems. Like you outlined, it seems to be an empire that might be in decline. However, when you look at China, it also seems to have similar problems, demographically speaking, potentially financially speaking. Sure, they have access to critical minerals, but they're a net energy importer in the world. How do you think that conflict could potentially play out? And is China potentially a paper target that we might be looking at?
You raise a very interesting question. China has a very large population, this we all know, as India does. I think India has the better potential long term to be a dominant country than China because, as you pointed out, the demographics in China are horrible, horrible. The population is going to decline significantly. You know, there are plenty of examples where a large population wasn't particularly helpful. I mean, the Dutch dominance in the world at the time, a country with a small population. The British Empire was ruled by very few people. The British army wasn't very big. And you look at the Portuguese, that also had an empire, and the Spaniards and so forth. They were not huge countries compared to, say, at the time, India and China and so forth. I don't want to sound overly negative about the US, but my sense is that the US is no longer the US that you encountered around the Second World War, with the enthusiasm people had to go to war and win wars, you know, and have leaders like George Patton, who really were brilliant generals. I don't see that nowadays in the US.
Talking about the financial system, global financial system for a second. Of course, like we outlined, the incentive is to print money if we look at government debts and if we just look at the incentive of the central bankers. How does this play out? Because, you know, in history, when we look at, for example, the Weimar Republic, Germany before the Second World War, they had hyperinflation. However, they were in their lonesome in that respect. Now it seems that almost every fiat currency has a government behind it that has incredibly high government debts.
Yes, this is a good observation. The Germans were the ones that they basically had to print money because they owed so much money as a result of the Treaty of Versailles that there was no other way. But that led to the German mark collapsing in value against the US dollars and the British pound and so forth and so on. What you said just now, that basically all central banks are printing money, is correct. And that's why, when you ask the question is, why does gold go up? Well, if you ask me, Mark, what is your favorite currency in the world? Do I mention the Swiss franc, which is very high and the economy is not growing? Do I mention the euro? The euro, which has a central banker, a lady who is a convicted criminal and completely incompetent, but she's a bureaucrat. She's a bureaucrat, but an incompetent central banker. And then you have the US dollar, and we know all what the problems are of the US dollar and of its indebtedness and its dependence on foreign capital to finance the US. And then you have Bitcoins and Ethereum and Ether and whatnot, and the precious metals. And then, the young people, they like these the cryptocurrencies. But in my view, a safe currency beyond, and I don't regard the cryptos to be safe currencies. That I don't. But I regard gold, silver, and platinum to be safe currencies. We have to understand they are safe as long as we have peace. Let's say you are the evil Mr. Maduro and you conquer my country, you kidnap me and so forth, and then the gold is stored in my pockets or in my private plane or wherever, and you can then seize it and expropriate me. But that's why intelligent countries, or countries, I have to rephrase this, that are run by intelligent people and not politicians. These countries, they repatriate gold into their own sovereign state and store it in China and in Russia and in Kazakhstan and in Brazil and so forth, and not at the Fed or in Fort Knox in the US. I think you have to be brain damaged to hold your gold or your foreign exchange assets in the US, because then you're hostage to the whims of politicians at the present time.
And Mark, I'm trying to get a sense for how this potentially could play out. Do you think we can kick the can down the road a couple more years, maybe even a couple more decades on this global financial system? Or do you think we'll see at some point cracks appearing and, shattering the system as a whole?
I have to laugh because, when I started to work in 1970, I started on Wall Street, and in 73, the company I worked for, an investment bank, they sent me to Hong Kong to build up their Asian business. Anyway, I did that. And at the time, I never thought that certain things would happen, including I never thought that we would have negative interest rates in the world. I had studied it when I studied economics, and there was actually a kind of a weird character, Guido Gesell. And this Gesell, he was sort of an anarchist, and so he was kicked out from Bavaria, but he settled down in Switzerland, in the Jura. That's why we know him quite well in Switzerland. And he was a nutcase. He suggested that you introduce negative interest rates, so it would force people to spend money. They said they couldn't keep money. Anyway, the other thing is, at the beginning of the 1980s, I befriended the strategists at Merrill Lynch. They were very famous, Dan Salvigson, and one was called Aronstein, and one Charlie Minter. And they were publishing reports that were beautifully done in colors and so forth. And in their view, and they were highly respected, these strategists, in their view, the debt growth in the US, which had picked up under President Reagan, would lead to catastrophe by the end of the 1980s. Okay, we had the 87 crash, but we didn't have a catastrophe. I am the one of the economists who thought that the debt would lead to disaster 40 years ago, and I'm still waiting. It hasn't happened yet. But there were some crises that happened, and my view is that we're getting closer to it, because in previous periods, you could print money, and the money printing had, in most cases, a relatively favorable impact short term. But you understand, at the present time, if you print money, in my view, the price level will go up more than wages, and the real incomes will go down. So what you then have is an economy that, in nominal terms, they will show growth. They will show, oh, GDP is up 4% and so forth and so on. But in reality, measured in gold and silver and platinum, honest currencies, it will be down. And I can assure you, you can ask your parents, the standards of living of most young people today is lower than their parents 50 years ago. I'm telling you, this is the fact. When I started to work in 1970, my salary was relatively high compared to my rent and compared to property prices, and with my salary I could buy much more Dow Jones or Standard and Poor's indices than I can with a salary today. In the 70s, salaries were high and asset prices low. We can measure that. And nowadays, asset prices are in the sky and salaries are relatively low. And Goldman Sachs last year published a figure that shows the affordability in the real estate market, residential in the US, is at the lowest in history. This is the fact. So now you can print money, as you say, but the impact, in my view, will be rather negative than positive.
Do you think it is likely that we will see a remonetization of gold to go back to an honest currency, which might solve long-term a lot of problems that we're talking about anytime soon?
Well, I think it's a possibility, and maybe some people will try to do it. But you understand, first of all, we never had a strict gold standard. That is a myth. But we had close to a gold standard. Bretton Woods was sort of built on a gold standard. But with the politicians we have nowadays, I don't think they will want to have some sort of gold standard. They rather have cryptocurrencies which they can multiply like water.
All right, well understood. These trends that we're talking about, Mark, this money printing, inevitable money printing that we've been talking about, how can one set up their life, portfolio, career to potentially benefit or, come out stronger on the other side and have this as a tailwind for themselves?
Yes, I tell you exactly what you should do. When you're born, you must choose parents that have big houses in Amsterdam, London, Paris, Zurich, New York, and so forth, and rich people who own painting collections and stamp collections and gold in safes and so forth. That you have to do. So before you're born, you better check who your mother is and who your father is. And number two, if you couldn't do that because you were not properly educated when you're born, you can still choose a profession that benefits from asset price increases. And these professions are usually, like real estate brokers or stock brokers. When money is being printed, the money doesn't get to the cleaner, to the worker, to the cobbler. You understand? It goes first to the financial people. And then it flows from the financial people to other people. But the financial people get it first. That's why in high inflationary times, you want to be in financial institutions that first of all, Wall Street controls the Federal Reserve. They tell the Fed chairman, you should do this and you should do that. And they pay the Fed chairman when he retires or even when he's there, large fees when he gives a speech. So you understand, you can influence a politician or a bureaucrat by paying him fees. This is very alluring to people. And so you want to be essentially in the financial sector. I'm not particularly intelligent, but I was lucky to be in the financial sector. And so the assets increased in value over time.
You've talked a lot about gold, silver, and platinum, and I would love to talk about those other two for a second. I think the role of gold in this is very clear. Central banks hold gold as a settlement currency, so it's very clear. But silver and platinum are perhaps a bit less clear why they would benefit so much from high inflationary times.
Well, I mean, silver has been used as a monetary unit throughout history. There were gold coins and silver coins. In the silver market is maybe sort of more industrial than the gold market. The gold market is principally jewelry and accumulation as an investment. But the silver market is largely an industrial market, and there are years during which there is a supply shortage. In other words, the usage, the consumption of silver is much larger than the production of silver. And that is very conducive to higher prices. And in the case of platinum, the supply of platinum and the above the ground value of all platinum is tiny compared to gold. So there are times during which the price of platinum is higher than the price of gold. And I think we're in a phase during which platinum will go up more than gold. And this is my view. I mean, other people have different views. I think that this bull market in platinum will eventually lead to higher platinum prices than gold prices. So this is the answer to your question. But I also want to point out to you that numerous of my predictions or my thoughts about the future were wrong. You understand? I'm not dogmatic. I'm telling everyone you should diversify. You should have some assets in real estate, some assets in cash and bonds, some assets in precious metals, and some maybe collectibles or commodities, you understand, and stocks. I frequently identified bubbles, but I also frequently identified the markets that were very cheap, very inexpensive, and very depressed, like Hong Kong a year ago. That was the market. Or Turkey 3 years ago, Argentina 2 years ago. These markets were very, very cheap. It's difficult to find markets that are very, very cheap nowadays. But I think Latin American markets look reasonably attractive.
A great place then to start looking, potentially get some bargains going. Talking about equities for a second, you referenced that as part of a diversified portfolio to benefit from this money printing trend.
Yes.
How important is it to select the right ones, the high quality businesses that can offset their costs? And how important is price when you allocate your capital towards equities?
For me, there's only one thing that interests me, is the price of a stock. What the company does, or whether it's well run or not. They're all badly run eventually. They're like governments. But the price of an asset, it's like Hong Kong property stock, as an example. The property price in Hong Kong will go up, say 100%, and down 50% or whatnot, something like that. But the property stocks, they will go up until they sell at a premium to the asset value of the company. And then they will go down and sell at a huge discount to the price of the assets. And that is where you make the money in the stock market, when you can buy things below the asset value and sell them way above the asset value and so forth. So there are opportunities, but occasionally you buy something that you think is cheap, and it becomes cheaper and goes to zero or below zero. that has happened as well. This is also something that in my mind I never thought about, that oil could be at a negative price, which happened in February 2020 during COVID.
Talking about cheap things, do you think oil currently is cheap enough?
When gold was at 250, everybody was bearish, and then you ask yourself, is it cheap enough? You don't know. But I think that when I look at oil and I compare the price of oil to, say, the price of houses, or I compare the price of oil to the price of silver, gold, platinum, then oil is very cheap. It's a bargain. And I'm a believer that demand for oil will go up and the reserves for oil may go down. I think that the price, actually, I just bought some oil stocks recently, and I will buy some more because I can get oil stocks. They have a dividend yield of 6%. Some have a 10% yield. I like dividend stocks. I'm not a very good investor, but I like cash flow.
Mark, I would love for you to talk a second about the Gloom, Boom and Doom report.
Yes, I have a newsletter and so forth. I write. My readers in general, they like my reports, but it takes time to read them. I mean, it's not a report that can be read in 5 minutes, and I say buy ABC, XYZ, CDS, and 10 stocks and sell the other 10. My letter is more for people who like to think about the impact of society, of social systems, of political systems, of geopolitics, of economics on asset prices. I mean, I'm fascinated by the movement of prices in the world. Already as a child, I was kind of interested that some prices went up and some prices didn't go up and some prices went down. I mean, when you look at the impact of China on the world, it had a huge impact in the sense. I mean, I went recently to a department store in Switzerland and I bought a few things. I was actually stunned how cheap they were. Because I remember my grandparents had one of the first TVs in Switzerland. They were affluent and my father was affluent and so forth. And it was a machine that was black and white. There were two programs, the German program and the Swiss program. The Swiss program you could get in French, Italian, or German, but it was the same program, the Swiss TV. And it aired, they had the TV from 6 o'clock at night until 10 p.m. Then it was finished. And on Saturdays and Sunday, they had some TV in the afternoon at 2 o'clock. And I remember they bought the TV in 1954. Then we had the World Soccer Cup in Bern. And the final was Czechoslovakia against Germany. And it was raining and raining and raining, and the TV never worked because during rainy times they couldn't broadcast properly. And the Germans then finally won because they had the first shoes in the wet terrain, the grass, that had these stips. So, you know, what soccer shoes are nowadays, but before that they were flat underneath, so people were sliding when the grass was wet. And the famous soccer player at that time was Pushka. He was a Hungarian. Yeah, the finals were Hungary, Germany. And the Hungarians were way ahead at the beginning, but then the Germans caught up and beat them. And everybody was sad because at that time, you know, 54 was shortly after the Second World War. The Germans didn't have such a good reputation.
It is a completely different world. We'll make sure to put a link to your newsletter in the description. Mark, it was a true pleasure. Thank you so much for your time and your insights today. Really appreciate it.
It's my pleasure. Thank you very much for your time. If things go down, we're talking about the major financial crisis, and then I want to be probably in precious metals, but not store them in the US.
Great final thoughts to leave it on, Mark. Thank you so much.
Okay, bye-bye. Thank you.
This podcast is for general information purposes only and does not constitute investment advice, an offer, or solicitation to buy or sell any securities. The views expressed are those of the host and guest and do not necessarily reflect the views of the company or their affiliates. Guests on the show are not compensated for their appearance. Certain discussions may include forward-looking statements subject to known and unknown risks and uncertainties that could cause actual results to differ materially. Listeners should do their own research, consult a licensed financial advisor, and not base any investment decisions solely on the information discussed. For a full disclaimer, please visit our website, and for full disclosure and risk factors of any companies referenced, please see full available disclosure and risk factors on their CEDAR Plus at www.cedarplus.ca.